Welcome everyone, this is John Sheely by Traders Country Club. This video will discuss the capabilities of a new strategy created by Traders Country Club and my new book entitled Common Sense Technical Analysis. As you know, almost all traders know the terms support and resistance. This video will demonstrate the step-by-step process of finding potential trades in the equity market. Before I begin, I must disclose the needed risk disclosure. There's a high amount of risk involved in all types of trading. This includes stocks, options, futures, and forex. Trading is not suitable for all investors, and past results may not be indicative of future returns. I have created a trading strategy that uses price support or resistance, or what some traders use the terms demand or supply. The charts and program that I use to create the strategy is TradeStation. Of course, I've created many algorithms in TradeStation to analyze the daily trend as well as other tools. During this video, we're only going to focus on support and resistance while using daily prices. Most everyone is familiar with the concepts of support. In general, there has been a previous price low where the bars are both above and below the previous support area. What we're looking for is prices have risen from this support area, but as you can see, prices are beginning to fall again, and we're basically getting very close to this previous support. So here's what the question is this support going to hold prices again? Are buyers going to increase demand at a price level that, quote, holds the price, or let's say test the same prices again that we've seen previously? So this is the question that we need to answer. If we see current prices approach the previous price support, should we place a long position? And if we do, where should we go long? This can be more difficult than many traders realize. Let's say prices move lower, but the buyers hit higher and higher asking prices just above this previous support area. The swing low price may not have been reached by actual prices. And so what's happened is that prices began to move higher and higher. So if a trader required that the prices actually touch this actual price support area, they may have missed an excellent buying opportunity. The opposite can be true. If a trader places a long position immediately just before this price support area has been reached, prices may continue to move lower and lower, causing a losing trade. We solve these problems by creating a new algorithm and trade strategy while using TradeStation code and a future application. Let's start at the beginning. We have daily prices in Home Depot. I placed a 50-period moving average in the chart just so we give us a better sense of the trend. What I've created is a price zone that is above and below price support. I do the same for overhead resistance that is above and below the price resistance area. We will only buy long if the current prices move within this price zone. If prices do not move within this price zone, we will not place a long position. Does this mean we immediately go long just because prices reach this price zone? No. This is because prices may just move lower and lower and potentially fall within our zone of acceptable price zone. This is why I must create a second condition before I buy long at support. I must wait until actual prices bounce above the current lows to indicate that we have found a new swing low or, quote, double bottom to set up a long entry. In the daily chart in Home Depot, we see the example of the concepts that we're going to use for our strategy. We see the previous support area, but instead of just one price, we have created a higher and lower price zone. As long as prices have stayed within this acceptable price zone, we'll place a long position, but only if prices have risen above the lows at an acceptable distance above the current lows. Traders Country Club actually has created a strategy that automatically enters the trade, determines the number of shares based upon the dollar risk for the trade. It actually enters the profit objectives, and enters the stop loss levels as well. It is able to do this automatically. For our strategy, we use the daily chart to identify the swing lows and swing highs. We use the 5-minute charts to trigger the trade based upon our criteria. Prices must be within that 3-price zone to set up the trade. And prices must also bounce above the lows by a certain amount to trigger the trade. If the long entry is triggered, the profit objective is automatically entered. This chart illustrates an example of 3 separate profit targets. Of course, the stop loss is automatically entered. The distance of the price targets and stop loss levels can be adjusted by the trader as the strategy input. I illustrate another example in this recent trade. We have the 3 requirements to take the trade. This is an example of a new long entry. The lows are just below this price zone, and the bounce from the lows was high enough to trigger the trade. While I say automatic to our strategy, there is 2 inputs that is required for the trade. The trader must place the trade for the following day. 115 means 2015. 05, of course, for the month and the date. For example, 2015, May 26th, is 115-05-26. The trade entry will only be executed on that particular date. There is a reason for that. In order to improve traders' performance, every trader must have a broad analysis of both the individual stocks as well as the broad stock market as a whole. This is going to allow a trader to have better selection for which stocks to make and which stocks to avoid. The second input is the support or demand price. We discuss the other inputs in the TradeStation code at another time. This chart illustrates the 2 inputs: the buy date that can only occur on the following trade date and the demand price for the previous swing low price. There are several long entries in our chart. The number of shares that we actually enter for the trade depends upon the dollar risk for the trade. The lower the dollar risk chosen by the trader, of course this means that we're going to lower the number of shares that we're going to execute for the strategy. The code then automatically adjusts the number of shares that is executed for these different price levels. Once the first target is executed, a break-even stop-loss level is raised to the entry price level. The same concept is used for short positions against resistance. This chart is an example of a short entry. Another example of a short entry in IWO. Another example in RF. Notice that the lower prices of the stock actually allows a higher number of shares with a smaller dollar risk. The Command Central radar screen lets the trader know what trades may be setting up. The swing values are calculated. The swing low for the support and the swing high for the resistance is shown in the radar screen. Once prices approach the potential demand, the high and low range must be within the range before we can allow a long entry. If the daily low is above the high range, no trade was going to be executed. If the low of the day is below that lower range, then we're not going to execute the trade as well. Traders Country Club will illustrate many examples in the future. This is just one strategy that we're going to use for our membership at Traders Country Club and our online courses. Our trade recommendations and membership services are going to begin in the middle of July. This is John Sheely with Traders Country Club.